webinar on the forthcoming budget outlook and expectations. I'm Deepak Jasani here, and with me I have my colleague Himanshu Parmar. Now, as usual, these are times when there are a lot of build-up of expectations as to what will the FM do, how will the FM correct the macro situation, and how will the FM benefit me as an individual. So now let us look at what are the expectations, what are the outlook at this point of time. Now, this budget will come at very crucial time. The COVID impact on the government financials and on the micro performances has not yet ended fully. Economic activities are not yet normalized, but thankfully the revenue collections have been quite good. Despite low economic activity in some months of the past year. This is more to do with the rising commodity prices, as a result of which the indirect taxes went up. Direct taxes also went up, especially the corporate side, because corporates have been making a good amount of profits. Now, but at this point of time, we also have the risk of withdrawal of monetary stimulus, which is being carried out by most global central banks, and as a result of which we have been seeing fund withdrawal by the foreign portfolio investors or FPIs. The budget needs to give the right signals to the local population as well as the foreigners, so that the current situation can be remedied in the best possible manner. The divestment target last year was a bit aggressive and may not be achieved. We have done barely 10,000 crores so far versus 1.75 lakh crores budgeted. LIC divestment may still happen going by whatever the announcements are in the second week of March, provided the market conditions remain stable. The combined deficit, the fiscal deficit of center and state remains very high at close to 10% or a little above that. Now, this situation cannot continue forever. The international rating agencies or the global rating agencies will not take it lightly if this situation continues for long. They have given the benefit of the pandemic related difficulties to India so far, but going forward, if the situation of pandemic comes under control, we will have to take steps and measures to bring the fiscal deficit under control, both at the center and the state level. Now, if in the coming year we have extension of free food grains and higher spend on Manarega, then it could again upset the fiscal deficit calculations for the next year, unless it is compensated by other higher revenues from other sources. The budget is expected to provide to exempt Euroclear settlements from tax. Now, this will facilitate inclusion of Indian sovereign bonds into the global indices. Corporate sector has been doing quite well over the last few quarters in terms of at least the top line. Even the bottom line has been good, except for some margin pressure lately. Now, this has happened mainly due to shift of businesses from unorganized to organized, where the corporate sector's market share has kept on growing. Now, this also means that the MSME as a sector is under trouble. It was under trouble a few years back. It is in trouble. So the budget will have to address the situation at the MSMEs and provide them adequate relief. Having said all this, I think the impact of budget on the equity markets is declining year after year because policy measures and announcements keep happening across the year and is not just concentrated in the budget document. And the impact of the budget will sort of wither away in a matter of couple of days. The markets will then come back to the prevailing trend and largely ignore whatever was mentioned in the budget. So, having said this, now I will hand over I will invite Himanshu to take us through the basic budget definitions and the budget maths and some sectoral expectations. Yeah, now over to Himanshu.
Hello everyone. So as we all know, budget is one annual event that all Indians we wait for it. As Deepak Jasani rightly mentioned, the impact of budget has been gradually reducing over the years, and the impact on market as well. So let me just break down the basic numbers for you and make you understand what exactly is the budget, what is fiscal deficit, and why it matters to you. Budget, broadly speaking, it would include revenue budget and capital budget. So capital budget is basically those expenditure that the government incurs for creating assets, mainly infra-related assets, roads, railways, and for rural development. Whenever expenditure of a government exceeds their receipts, the government runs into deficit. Running into fiscal deficit is not uncommon as such. So basically, fiscal deficit is mainly funded by bank borrowings or institutions, public and also overseas institutions. So fiscal deficit is basically when the government is living beyond its means. So by running into high fiscal deficit is very much problematic. We have seen in FY21 the fiscal deficit as a percentage of GDP has shot up quietly to support the economy, which was hit by pandemic. So now was the government focus would also be to ensure that the fiscal deficit as a percentage of GDP goes down and there is fiscal consolidation which is being monitored. So in that sense, running into high fiscal deficit impacts us all, because higher fiscal deficit would in turn lead to more dependence on on the borrowings. Higher borrowings would ultimately lead to higher risk-free rate for the country and overall increase in the interest rate for the economy. So this is how fiscal deficit number would impact us all. It would increase the interest rates in the economy at large. So fiscal deficit is usually calculated as a percentage of GDP. GDP is basically the value created for production of goods and services in an economy. So GDP are basically of two nature. One is the nominal GDP and one is the real GDP. So real GDP basically considers the actual growth, the real growth in the economy. It does not consider the inflation impact of it. And the nominal GDP considers the inflation impact. So all these definitions that I explained you briefly earlier, it would be much more clearer when you see this summary fiscal math. So here we have listed the broad particulars for the overall financial budget of the government. So here we see the tax revenues and the total revenues and total expenditure, which will lead to fiscal, which arrives at the fiscal deficit number. So on the tax revenue side, we have the direct tax, indirect tax. Direct tax would include our income tax and corporate tax. Indirect tax would include GST, customs, excise, and other indirect taxes. In the non-tax revenue side, I've included the capital revenues also. So basically, it would include the dividends and the profits of the PSUs, the disinvestment receipts, the grants that we receive from external agencies and international bodies. Coming into the next line of item, which is revenue expenditure. So revenue expenditure is basically allocation of all the expenditure for various ministries and departments of the government to ensure that they're working to achieve their specific goal. Capital expenditure is mainly towards rural development, the defense, toward infrastructure, basically creating assets which would give a long-term impetus to the country's economy. So as you can see, we have also, if you see the last column, we have added a column of our HDFC Bank's estimates. So fiscal deficit as a percentage of GDP, based on the budgeted estimates, it was around 6.8%. Expecting that LIC disinvestment could happen by the end of this fiscal, we expect that it would be around 6.5%. overall, in this fiscal, the tax revenue that the government received may both on direct and GST side have been quite stellar. You can see for the past six odd months we have seen GST collection of more than 1 lakh crore. So overall tax buoyancy would help in ensuring that the fiscal deficit does not shoot up drastically. So having get a clear idea with respect to what basically is a fiscal deficit and what are the key figures that are being considered, let's just deep dive into the sectoral expectations that we have. So coming to the most important sector of all, the infrastructure. So the government, the asset monetization would be a center focus and would continue to remain so. Basically, the government is trying to monetize its road and highways asset, basically all the assets that NHAI has. So National Housing Authority, National Highway Authority of India. So mainly all the asset monetization is done through the InvITs road, where investors like us invest in that. So public investments in infrastructure projects is something that the government will look into. So to promote and to enhance the popularity of this particular route of InvITs, the government would could consider giving tax incentives also. It might consider to bring this particular investment option at par with equity, and maybe perhaps reducing the overall holding period of the InvITs from the current 36 months to 12 months, and perhaps shaping the tax, giving tax incentives in a matter that they could speed up the monetization process of the highways, which would further go for monetizing and for further road and highway infrastructure related projects. Moving on to the next one, which is the real estate sector, we expect that the government would continue with the interest subvention scheme. So it is basically for the basically covers low cost housing. So the extending the limit from current 25 lakhs to 35 lakhs is something that could be in pipeline in the upcoming budget. Also, the credit link subsidy scheme under the Pradhan Mantri Awas Yojana to ensure for the middle age for middle income groups in the rural sector, that credit limit can be also extended to support the overall real estate sector. There are also hopes that the current limit of interest deduction of 2 lakhs could be increased by 50,000 or maybe to maybe bring it to 3 lakhs. So something on similar lines, if could have if done, then it would give a really boost, give a real boost to the real estate sector. Coming on to the sector which is more or less linked to the infrastructure and real estate, which is cements, paints, and other building material sector. Increased allocation could be expected in quite a few government schemes, which is Pradhan Mantri Gram Sadak Yojana, Pradhan Mantri Awas Yojana, and Manrega schemes. All these would be used for more for development, and increased allocation would enhance the cement consumption and other building materials production. Also the smart cities and housing for all projects schemes could also see an extension. Housing for all, which is nearing its deadline in 2022. Perhaps additional scopes that they give, or maybe extension of the time period would give a big boost to the overall building material sector at large. And now coming on to the chemical sector, the government could consider tweaking of the custom duty structure of certain raw materials and intermediaries, so that it will give an overall boost to the production to the chemical production companies in India. It could also consider export incentives and for certain product categories. So last for the past few months we have seen a rise in commodity prices. So due to such a sudden rise in these commodity prices, we could expect that the government would consider higher subsidy in the fertilizer segment. So both nutrient and urea-based fertilizers could see higher subsidy in the upcoming budget. Coming on to the automobiles, we all have been very much in the last 1 year, we have been talking about electric vehicle space. So maybe that particular space could given a priority sector benefit, and the banks and financial institutions could be incentivized to lend in this particular space to boost the manufacturing. Also, currently, the import duty on fully built-in EV units is same as what the traditional combustion engine units. So maybe perhaps a rationalization of import duty could be expected, and perhaps we could see some global OEM players would be interested to cater to our market. So maybe this would be something which Tesla would also be seeing from the upcoming budget. Extension of the frame subsidy scheme for the EV space, which is basically a subsidy scheme for all the consumers. More details on that and how they are planning to take it forward would provide comfort to the end users to accept EV and the cleaner solutions in the automobile space. Coming to the next sector, which is the BFSI sector, we also how the MSMEs have been impacted during the pandemic. So also we have seen that the government through time and again through their staggered announcements, they have been extending the ECGL scheme, which is the emergency credit guarantee scheme. Perhaps extension of the same could be expected in the upcoming budget. This scheme has received quite a good response. Continued support from this end would give a big boost to the deeply impacted MSME sector. Also, as Deepak sir earlier mentioned about inclusion of the sovereign debt into global bond indices, so to faster or to quicken that pace and perhaps reduce the borrowing burden on the domestic institutions, the government could consider maybe rationalizing or waiving the capital gains tax for the overseas debt investors. Some announcement on this lines could be expected in the upcoming budget. So this would ensure that if at all the fiscal deficit is higher and if at all the domestic borrowing are not able to satisfy the necessary limit, then inclusion and global participation in the sovereign bond would be a good positive for the fiscal picture of the country. Also, given that agriculture is the overall theme, and agriculture has been given a push for for almost every budget, we expect that increased credit there could be an increase in the credit availability to that sector, which would maybe perhaps some schemes in lines that maybe it would lower interest rates or maybe for specific nature could be announced in the upcoming budget. Coming on to the important sector that we felt, the healthcare sector. So overall, we have seen how healthcare sector has been badly impacted due to the pandemic. So there is a need for medical training of medical staff and also the infrastructure. So perhaps a public-private partnership model can be worked out. So to create additional bed capacities in the country, which would mainly cater to the primary healthcare infrastructure, especially in the tier 3 cities and beyond. Also, the government could consider the skill development in the healthcare space. Maybe 1-year bridge programs, especially for nurses, could be considered so that they could at least administer specific drugs and procedures in rural areas. So also healthcare as a budget, we have seen the current allocations around 1.8% of the GDP. They have a target laid down to bring it up to 2.5. So perhaps increase in the overall healthcare budget is what we expected in the upcoming budget. Coming on to the next space, which is the pharmaceutical sector, India has been lagging behind with respect to research and development and getting in the right procedures and equipments. So on that front, there is a need to push the R&D and get more machines and medicines being produced and manufactured in India. So some scheme on this lines could be expected. Coming to the next sector, which is the FMCG. For the past 2 years, we have seen that a tax rate hike in the cigarettes has not happened. So perhaps it is likely that tax rate hike in the cigarettes could be expected. Also, if the tax rate hike is in double digits, then it could deeply impact the sector and the companies. Coming to another distressed sector which was badly impacted, the hospitality and the aviation sector. These two service sectors could see some limelight in the upcoming budget. Perhaps an additional support is required at this juncture because they have been beaten down quite dramatically in the past 2 years. The government could also consider inclusion of the hotels and tourism-related sectors in the national infrastructure pipeline. So by doing so, they would be getting access to funding at relatively lower rates, which would ensure better working capital management for the companies and the overall sector. Coming to the next, which is the logistics and export sector, we have seen how the freight-related situation have hampered because of supply chain issues, and all the exporters have faced quite a few issues and have been paying up two times or 3 times or 5 times of the freight charges. So perhaps a freight subsidy to certain qualified exporters could be announced to provide a temporary relief and to ensure that there is cost competitiveness. The government could also introduce a warehousing policy and national logistics policy, which would ensure a clearer and a holistic holistic policy, which would basically cater to this logistics space. We also expect that BPCL privatization could receive a new impetus, given that we are expecting that LIC disinvestment could happen in this fiscal itself. So in the next fiscal, the disinvestment receipts could get a big boost from the BPCL privatization. Coming to the last sector, which is the telecom sector. So currently, that all the telecom equipment manufacturers have been deeply impacted. So perhaps rationalization of custom duty would be something in the books that the finance minister could announce in the upcoming budget. Also, with to ensure that the overall fiscal consolidation happens and overall fiscal deficit is reduced down drastically, the government could also announce 5G auctions maybe in the last quarter of the next fiscal. So this can be watched out for. So this would perhaps add to the revenues of the government. So that's it with respect to sectoral expectation that we had. So
Deepak, thank you. Like to add. Thank you, Himanshu, for a very lucid coverage of the fiscal maths and the sectoral expectations. Now, broadly, so what is needed at this point of time? Basically, a balance between fiscal prudence and providing support to the COVID-impacted segments is what is the need of the hour. Government also needs to wind down the pandemic stimulus, because that is weighing a lot on the current fiscal situation. Then we also need to have a credible and practical farm reforms, especially with regard to MSP. Now, we have seen what happened in the past year on the farm reform front. So a little more thought process, a little more balance between the various stakeholders, but at the same time, reforms that can lead to doubling of the farmers' income soon enough are the need of the hour. Then we also need to continue with the Atmanirbhar policies and other announcement and policies of the last budget. So execution of whatever has already been announced is equally important than the making new announcements. We need to execute the past announcements and past policy. Then we need to continue to spend efficiently on infra. Infra spending has to be a little prudent and efficient rather than just splurging money on creating assets and taking debt, which will be a burden for future generations. Then we need to create new sources of revenue for the government, including monetization of assets. Government has already hinted at a policy of monetizing assets and given a budget for amounts to be raised over the next 3 or 4 years. Of course, FY22 maybe we have not been able to do much, but FY23 onwards we expect a higher traction in that direction. Divestment has also to sort of be taken forward in a realistic and speedy manner. Because of pandemic, I think the last two big divestments have got delayed. Now LIC may happen by March, BPCL maybe next year. There are already some 40, at least 43 more PSUs which can be sold strategically. And next year probably 1.2 lakh crore worth of divestment receipts can be budgeted. Then laws industry as a industry's contribution to the GDP has fallen over the last few years. Services has grown in importance because what has happened is we have become import dependent for a lot of items. So this Atmanirbhar India is in the right direction. So we need to restore the industry's importance or contribution to GDP to the earlier levels, so that we can reduce our dependence on imports and we can create a lot more jobs. Rural demand has been impacted of late. Now that is due to stagnant agri prices, troubles for the MSME sector, which are mostly in the rural and semi-urban areas, and low urban remittances because of the disturbances due to the pandemic. So these three things have impacted the rural demand. Now this has to be corrected in whatever way. Now pandemic related impact cannot be tackled in any substantial way because that is something beyond the control. But I think as far as the MSP is concerned and as far as the MSME troubles are concerned, concrete measures need to be taken in that regard. Cost of capital or cost of funds across the economy has risen lately, and going by the budget, the fiscal deficit projections that many people make, interest rates can continue to rise going forward also. Now this has to be brought down. If this is not brought down, then the cost of operations by most businesses will go up. Working capital will become expensive, which again will impact their profitability and margins and pull back their incentive to expand or do more things in their areas of operations. So now in FY22, basically the nominal GDP growth can come in at about 18%, close to 18% versus about 14.5% budgeted. So basically because of the inflation in commodity prices mainly, the tax collections, the nominal GDP growth has gone up, and that is why it has led to higher tax collection. If as Himanshu also pointed out, if the LIC divestment happens by March, we could end up with a 6.5% fiscal deficit. Otherwise, we could end up with about 6.8 to 7% fiscal deficit versus 6.8% budgeted. However, this is better than 9.2% in FY21. But as compared to what was the fiscal deficit in FY17, FY18, we were at less than 4% or around 4% fiscal deficit. So from there, we have deteriorated. From 21, we have improved, and in 23, we need to improve even further. So in FY23, we feel that the budgeted fiscal deficit could come in at close to 6% of GDP. From 6.5 or 6.8, which whatever is the final number for FY22. But this will be despite that nominal GDP growth will come down from 18% last year in FY22 to about 13.5% in FY23. So tax collection momentum will could reduce. So we will have to rely more on efficient collection of taxes, widening the tax net, as well as in the non-tax revenues. Gross borrowings by the center could come in at 13 to 14 trillion rupees, and states will borrow another 6 to 7 trillion rupees. So, with such a high borrowing, they will crowd out most of the private players, and interest rates could continue to remain high. So, fiscal deficit, as long as it remains high, the interest rates cannot come down quickly. The sovereign debt inclusion in the global indices will give some temporary relief. But if we don't improve on the fiscal situation, then that benefit also may wither away very soon. Now, dependence on small savings will remain high. Government will continue to budget more and more collection from small savings. We don't expect much changes in the personal tax or in capital market transaction tax, except that the basic exemption limit for income tax may be lifted a bit to benefit the low-end taxpayers. So now India faces challenging times currently. We have discussed that in this webinar. Our trade deficit is widening. Partly it is a good sign in the sense that our businesses or our industries are reviving from the pandemic-related slowdown. Fiscal deficit is also rising and much beyond the comfortable levels. We had the FRBM Act. We have seen revision in that targets over the last 2 or 3 times. We have not been able to stick to the fiscal deficits which we have forecasted, and we have some reasons or justifications for that, like COVID pandemic. But I think we should quickly go back to that path of fiscal consolidation as soon as possible. Interest rates and bond yields continue to be very high in India, so this also cannot last for long. This also contributes to inflation, and high inflation and high interest rate combination will have its own impact on currencies. So FPI outflows we have seen lately over the last 2 months or so, mainly as a reaction to the end of monetary stimulus and expectation of rising rates. So this is also one of the challenges that India continues to face. So now budget, the forthcoming budget is one of the tools to correct all these shortcomings. Now, so let's see how much does the finance minister succeed in this endeavor. Yeah. So now, do we have any questions? Let us see whether. Right. Rajgopal Iyengar, Mr. He says that worldwide rising interest rates to stem inflation is a cause of concern. How do you see this move by central banks like Fed and RBI, etc.? So here the central banks have little choice. Basically, they have loosened the monetary policy in reaction to situations like pandemic or even earlier. So now, when the inflation continues to be high, there is no choice but to raise interest rates to try and stem the inflation. Now, inflation can be on 2 accounts. One is demand side and supply side. So to curb the inflation, higher interest rates will help in curbing demand. But if the supply side issues are leading to inflation, I don't know how much will rising interest rates help in controlling the inflation. But for the time being, I think the central banks don't have a choice, and they will have to keep raising rates. Now, one thing that can happen going forward is that currently the central banks have laid out a roadmap of raising interest rates very aggressively. If, for example, the inflation comes under control sooner and the growth rate continues to remain sluggish, then the tightening or the tightening of monetary policy or the raising of interest rates may get delayed. So what was going to happen in a year's time may happen in 2 years' time. So that will give some breathing space to most businesses. Any thoughts, expectations on direct and indirect taxes? Mr. Guru Nandan Samsi is asking. So we have discussed. So now GST rates are discussed and decided by GST Council. So there the budget has very little scope to tinker with. Import and export duties is one thing where the budget can deal with. Income tax and corporate tax, most of the changes which were required have been made so far. So we don't expect any major changes in direct and indirect taxes this time around. Then which sectors will perform, and what about FMCG and pharma sector? So Himanshu has taken us through the sectoral expectations. Now, sectors which can perform going forward, FMCG and pharma sector, as long as the rural demand does not revive, the FMCG sector may not sort of perform in a big way. As far as pharma is concerned, COVID had a good beneficial impact on the demand scenario for pharma industry. Once COVID is out of the way, we will go back to the normal growth rate for pharma. So there also we don't expect a very big upside movement in the sector, but individual stocks can do well based on which drugs or which segments they are in, and whether they are in exports to the US or rest of the world, etc., etc. Now there is what is the benefit for senior citizen? That too we'll have to wait. Senior citizens have been given benefits in every budget, some benefit or the other. Now, whether any additional benefit is being provided or not, we'll have to wait and see. This investment of shipping corporation is expected in this financial year, or will it get deferred? Now again, banks, two PSU banks were to be divested, and one insurance company was to be divested, and shipping corporation was to be divested. So now these three things have not happened in the past year. They are smaller things. The government is focusing more on LIC and BPCL. So maybe going forward, I think these three will come back into focus once BPCL is out of the way. Maybe in this early second half of the coming year, we may see a lot of activity in these stocks, in divestment in these stocks. Any impact of Russia-Ukraine conflict on India exports, and any support for companies doing import substitution? So Russia-Ukraine conflict, how will it pan out? What will the impact? How long will it remain? We don't know at this point of time. But having said that, I think the crude oil prices, the natural gas prices will shoot up, and that will have an impact on most industries. Negative impact on most industry and positive on a few. Apart from that, pharma companies export a lot to Russia, so that may get disrupted for a few months. So that can be the maximum impact of Russia-Ukraine conflict. Will now be the time to invest more in debt funds? A good question. I think when the yields are rising, you can start doing SIP sort of investment in debt funds, because at some point we may see a reversal in the upward trajectory, and that at that point of time you will see mark-to-market gains on your debt funds. Budget impact on IT sector. No major impact on IT sector. I think IT sector has had a beneficial impact on the other sectors, in the sense that the wages in IT sector have gone up. So spending by them has benefited FMCG, consumer durables, travel, hospitality, etc. So as long as the wages, the net wages in the hands of the IT employees don't come down, we don't see any negative impact. For IT sector, I don't think government needs to provide anything. They have their own competencies, and they will keep flourishing going forward. Yeah, I think we have covered most of the questions. Right. Budget impact on Bank Nifty. So now banking, I think PSU bank as a sector may do well because of some specific measures or reliefs that the budget may provide. Number one. Number two, when the PSU banks, two PSU banks get divested, there will be hope and expectation of better times in the other PSU banks. So PSU bank as a sector may do well for a few weeks or few months. Private banks may be indifferent, may not be impacted either way, positively or negatively by the budget. Impact on real estate sector. That is the last question we'll take. Now, real estate may, I think Himanshu has had one slide on that. So, so if the real estate, if some soaps are given to the buyers of flats or residential properties, additional soaps, then the real estate sector will do well. As it is, the real estate sector has done very well over the last 1 year because of the fall in the inventories. A lot of people have buying up new flats, bigger flats, etc., etc. The rates of the flats have also inched up very marginally, but which is a good sign after a long stagnation phase. The prices of flats have started to inch up. So real estate sector actually does not need any major reliefs. They on their own they are doing well. But I think these few things which if the government provides to the home buyers, then probably it will be an additional benefit to them. Right. Thank you everyone for joining in this webinar, and I think I hope we have been able to add some value to you all. Thank you, and see you in our post budget webinar. Thank you.
Thank you.